Very good evening, everyone. A very good evening to all our esteemed clients, and a warm welcome to the eighth edition of Alpha Manager series. This is the second Alpha Manager series for this fiscal year. My name is Shulin Kamath. I'm a part of the investment functions team with Incred Wealth. Incred Wealth, as you know, we manage close to around 35 odd thousand crores of AUM across 4,000 odd clients, and we are a part of Incred Group, a diversified financial services firm and one of the fastest growing NBFCs in the country. The last 6 odd months have been a particularly challenging phase for the investor cohorts. They have had a very tough time navigating through the turbulent times. Trade wars, tech wars, geopolitical tensions, Trump's policies, all of these have kept the investors on their toes. The recently, concluded U.S.-China trade agreement and the ceasefire agreement between India and Pakistan have provided some degree of fillip to the domestic bulls. And the developments on the Indian macros, especially the high frequency indicators and the latest inflationary print, they have been comforting for the investors. However, if I were to use one word to summarize the kind of a scenario both on the global stage and the domestic stage, it is that of uncertainty. Incred Wealth on this backdrop brings to you the eighth edition of Alpha Manager series, and the topic for today is very pertinent. It's called "Making Uncertainty Great Again," in line with Mr. Trump's, "Making America Great Again," which he has been tom-tomming for the last 1 year or so. We have the guest speaker for today, Mr. Samir Shah, who is the co-founder and the fund manager of ValueQuest Investment Advisors. I'll just brief you about ValueQuest as a firm. ValueQuest invests in high quality companies with a proven track record. They intend to ride on the growth phase over 3 to 5 year time frame. They have a very unique framework which is called Scale, SCLE, which is the scalable companies with a competitive advantage, adaptive in nature with a long runway and a superior execution to call out the future leaders of tomorrow. ValueQuest AIF as a whole has a very significant track record, clocking close to around 32 odd percent CAGR returns with close to 5 year investment time frame. This is an alpha of close to 7 to 8% over and above BSE 500 as a benchmark. It's a pleasure to introduce Mr. Samir Shah to you. Welcome on the call, Samir sir. Mr. Samir Shah is the co-founder and a fund manager with close to 2 decades of investment and capital markets experience. He is a chartered accountant by qualification, and he has formerly worked with firms like FCH Centrum, Brick Securities, and Sharekhan in senior positions. He has a proven track record of identifying high conviction investment opportunities. So the next 30 odd minutes, Samir sir, is reserved for your views on the markets and the sectors, etc. And maybe the last 10 to 15 odd minutes are reserved for the Q&A session. I request all our guests to kindly log in their queries in the tab which is marked Q&A at the bottom side of your screen, sir. Over to you, Samir sir, for your take and the outlook on the domestic markets and the strategies.
Yeah, thanks, Shulin, for this introduction. And thank you all for joining. I'll just set some context before I get into the market view so that, just for the understanding of the kind of investors we are. While, Shulin, you mentioned a 5 year track record. I mean, of course, we have been managing client money. This is the 15th year of managing client money. So I would say if you put, three filters, the size of money that is managed, the kind of returns that we have generated, and the longevity of the returns. We've been largely PMS for the initial part of the journey, and now AIF, both Cat 2 and Cat 3. So we are focused on alternatives assets. No thought of getting into a mutual fund. We have dealt with limited number of relationships, but very large relationship, and these are all long term. So our focus is long term India equities. That is what we do, both private and public, largely public, and the promoter family background is maybe 4 decades into equity investing. So we have a legacy which is higher than what the fund life or the company life is. But that is where we come from. So because having been investors in the market, something has worked for us. See, there are many ways to make money from the market. There is something that has worked for us over a period of time, and that is what, when you said scale, that is what it is. If I have to say in one word or one line, what the objective of, even the inflection fund that has started just a week back, that is to catch companies that are going to change scale at their inflection points. So if you are able to identify trends, sectors, mega trends, companies at their inflection points, then you get both earning growth as well as valuation re-rating. So our success in the past has come from identifying these trends early enough and then betting big on it. That is the second part to it. Just identifying companies is not enough. You have to have the conviction to bet on them reasonably high. If you bet just 1% of the portfolio on something which is very high conviction, then it's not going to deliver the final outcome. So this alpha generated is an outcome. What we always aim to do is to try and identify these trends early, and then we follow a concentrated portfolio approach. It is a high conviction portfolio, and in an AIF, there is a SEBI limit of 10% of portfolio in a single stock. But you can safely assume that we'll go there in 3, 4, 5 stocks, where our bet sizes will be maybe 8, 10%, and rest also. If I cannot bet, say, 5% of portfolio, then I don't have conviction enough, or I have not done enough work. Personally, I've been 25 years in the market. 99 is when I joined the market. Similar time frame for Ravi. Ravi is the founder. So Ravi and me go back even before we founded this. Both of us have been in the market for 25 years, and then he's been the CIO. I've been fund manager, and this fund is modeled on VQ Growth, which is our flagship scheme from day one. Our approach is an investor's approach versus a money manager approach. What I mean by that is there is no hugging the benchmark. We will not do underweight, overweight. We will go where the puck is going to move. We will focus on areas where we feel money will be made, and we have a differentiated view versus the market. Not being contrarian for contrarian's sake, and we are definitely not, that momentum flavor of the season kind of investors. Typical horizon, as you mentioned, is 3 to 5 years. It's a rolling 3 to 5 year view. We don't look at anything with less than 3 year outlook, and we will not come and tell you that the stock has not done well for 2 years, but 10 year outlook is good. It's a rolling 3 to 5 year view. That is the sweetest spot for us. Our history and our performance has come from identifying these trends early enough. So building materials, chemicals, early part of between 2000 2005 15, then pharma, chemicals continued, then real estate, electronics manufacturing, defense manufacturing, CDMO. So all these are energy transition. Obviously, is the biggest. If last 3 years anybody has followed us, you would have seen that that is the biggest theme which we have been bullish on. So these are the trends that have reflected in the portfolios that we manage, which has delivered the kind of outcomes that it has delivered. So concentrated portfolio, sector agnostic, market cap agnostic. We don't think in terms of small cap, mid cap, large cap. I like a large cap, we'll buy a large cap. We like a small cap, we'll buy, but we have a minimum threshold. So in terms of risk management, that is paramount. What you don't buy is as important as what you buy. So minimum 100 crore profit is our threshold. We will not buy turnarounds. Bad promoters, bad balance sheets are out of question. We don't like one trick ponies or 0-1 stories. We need multiplicity of growth drivers. We will not bet on number 6, 7, 8 in an industry. We want to bet on only leaders, challengers, and disruptors. 10% of free float. 5% of the company if you bought, then needs further approvals before we go ahead. So we have built our own risk management frameworks, which eliminates a large part of the risk. We look at risk-adjusted returns. We are not in the rat race to generate higher or take undue risk to generate high returns. It never happens. If you eliminate risk, that plays a large part in your risk management. And like I said, liquidity is very important. 50% of the portfolio I should be able to liquidate in 3 days' time, and 10% of free float is where we cap our exposures at. So broadly, this is how the portfolios are managed. It is a combination of top down and bottom up. We have our own network now over the years where we validate, we do true 360 degrees. So when you are investing versus a money manager where there is, underweight, overweight, and if you have a 100 stock portfolio, then you can't go deep. Whereas ours is reverse. We only invest in high conviction positions, and there the kind of research that is required, the depth of research is much different from, say, a typical sell side research. And that is where the network comes of use, that we have now one enough vintage in the market to know what to avoid and what to focus on. Second is the network where you have to validate. You don't only go by what the company is saying in the con calls, etc. You meet everybody in the ecosystem. A competitor always knows if there are any bad practices that are being followed by a company where we are looking to invest. So we go to great extent in terms of doing our on the ground checks, and then it's our ability to connect the dots. So in today's market, uh, no, information is not the edge. So 20 years back, if you had access to balance sheet or the promoter, that was good enough for you to identify a stock idea before anybody else. No longer the case. Today, information reaches me as at the same time as it reaches you. So that is not the edge. In fact, there is an overdose of information and there is just too much noise. What you also mentioned, that in this 3 months also we've seen roller coaster. I have gone in 1.5 months from some calls asking if why we didn't create cash, to saying that why are we holding that 10% cash also in the portfolio. So that's how behaviors are, and if we start behaving like that, then that is an absolute recipe for disaster. So it's your behavioral edge, how you behave, especially when you take large positions in small and mid cap. So last thing I would like to say is, when I say risk management, finally it is the high quality. Your earning growth is your ultimate savior. If the company delivers on earnings, short-term corrections also, it's like a rubber ball versus a glass ball. The glass ball goes down and then there is permanent capital loss. A rubber ball bounces back. So if you have good quality, then good companies always bounce back. These challenges, see, you are an investor, you are a minority investor, you are sitting in a sidecar. So it is very important that the driver is very strong, and we spend most of the time there. So three filters: quality, growth, and valuations. Valuations is also important, but we don't, if valuation is the only good thing about a company, then we'll not buy. We need first quality. Only if a company passes the quality test, then we have the growth test, that is this company going to grow, or the growth is superior vis-a-vis the market? And is there something that we are able to decipher which is different from what the market perception is? And that is where, the scale change, if I have to just simplify it, if we are able to catch companies young, and if they go through that scale change, or inflection point can come from some regulatory change, management change, some product launches, some kind of a industry tailwind, some global event, whatever it may be. If you are able to catch the inflection point, then you get earnings growth as well as valuation re-rating. And 3 to 5 year period is a sweet spot to get that. So it's your behavioral edge and your analytical edge. When you get so much information, are you able to connect the dots and draw a picture which is different from the picture that the market is painting? And that is where big money is made. If not, then we are happy to let go. Because we have high quality and high growth, it is equated by some people as buy at any price. So that I want to be very categorical, that we are not buy. My job is not to find a great company. My job is to find a great stock. So which is very important, that you buy it at the right price, because a great company bought at a wrong price also can deliver flat or negative returns. So that is what we are very, very cognizant of. And so in that order, quality, growth, and valuation filter, only companies that pass all three filters finally come into the portfolio. And when it passes all these three filters, then betting 1-2% of the portfolio doesn't make sense to us. So this fund will have 15 to 25 positions. It has a QIB status, so anchor investing onwards, everything we can do. And yeah, like I said, top 15 positions uh, will form the bulk of the portfolio. So I'll stop at that in terms of how we manage money, how we look at stocks, because that is very important context to what I'm going to say now in terms of the market view. Again, this is a subset. This market view is a subset of the newsletter that we sent out at the peak of the tariff uncertainty, and then I have added obviously the latest events to that. So this is kind of up to date, but it's an excerpt from our market view, which we have for the last couple of months. So yeah, we are in a VUCA world. While whatever we are seeing, you enumerated it very well in terms of the roller coaster we've gone through just in this 2 months period. But to me, since 2016, we've not had a normal year. So every year there is something, starting demonetization in 2016, then you have GST implementation, you had that DHFL crisis, you had that SEBI restrictions, you had RERA, you had COVID, you had Russia war, you had uh, now our trade war, etc., Trump, our election. So every year, if you see, there has been something or the other that has kept the market on the tenterhooks. We've forgotten, I think, just less than 6 months back, everybody was saying that people will sell India and go to China, that we are not even talking. So it became like the shelf life of that event was just 1 month, but at that time when we were going through it, it looked like, oh, India is so expensive, China is so cheap, we should create 40-50% cash, or we should invest. I had this thing, why aren't you investing in China? And you just see what we were thinking at that point of time. And was China cheap? Yes. Did China give returns? No. It did went go up and then it came down. So there are second and third order derivative. It's not as simple. If somebody would have, my favorite example is 2021, when you had this Russia-Ukraine war, interest rates in the developed markets went from 0% to 5% straight. If somebody would have told me that we are going to have a war, we'll have a oil spike, we will have interest rate spike, and we will have $20 billion going out of India market, I would have said blindly that we'll go down 30%. In that period, my portfolio was not even down 3%. So, sometimes even with the benefit of hindsight and no matter what, so listening to economists, etc., you have to do at your own peril, because markets is a funny animal. In hindsight, everything becomes clear, but while we are going through it, and we are in that kind of a situation. So I equate it to, where skies are clear and flight, you have very, very smooth flight and you land safely and all that, you don't feel it. 2025 is a year which is going to be turbulent, because of more reasons than one. Trump has shaken up the world, and that is why the title of my newsletter was making uncertainty great again. And how do you invest in times like this is what we have to. It is rough weathers, and as a pilot or as a fund manager, I need to ensure that I have to take care of safety as well as reaching the destination. So we are in that kind of situation. I'll just turn the clock back 1 year, because what we have seen a correction, and now with the benefit of hindsight, what has been the key reason? According to me, even before Trump came, even before war or anything else, it was domestic self goal which started the correction. So our market were cruising along very well. India was one of the best markets. Everybody acknowledged that after US, if there is any market, it is India. Companies were doing well post COVID. Our results or corporate profitability was going through a great upturn. And then as it happens when things are okay, maybe government become complacent or whatever. So we had election. So if you see post COVID, all the other countries in the world have printed money, they've done demand side. So they have kicked the can down the road, taken on a lot of debt, but incentivized demand. India is the only country which has only focused on supply side measures. So hardly any demand side measures. Fiscal consolidation continued except for COVID. If you see, you had government fiscal consolidation, and that still remains. What it did, and especially because of the elections, the government spending really tanked. So this is what it is. If you see June 24, the orange line, which is capital expenditure. So our economy, if you see the legs to the growth, economic growth, consumption was low, private capex was picking up, but not as much, and government capex was doing the bulk of the heavy lifting. And that used to be, you see, it was a very high number, and then suddenly it dropped during the time of election. Typically, when this happens, there is a lead time, but after in 3 6 months, we saw it in India's economic growth. So September quarter, we grew at what 5.6% or something. So this did have an impact on economic growth. This was combined with the last toward the end of the term of Shaktikanta Das. He's been a rock star throughout, but towards the end, I think he was a hawk and he kept the rates high. He kept the deficit very high for a long period of time. So banks were scrambling for deposits. There was a LDR norm that was there. If a bank was growing at 15%, he'll go and say no, 20%, then he'll say no, grow at 15%, things like that. So every lender that you talk to, RBI pressure was there in terms of slowing growth. So this was a double whammy, that government slowed down and the RBI further slowed down the thing. And that really had an impact on our growth. And obviously, valuations were high. So what happens is when you have high valuations, you are expecting market always runs ahead. Market is not a lag indicator, it's a lead indicator. So some expectations were built in terms of say 15-20% kind of earnings growth. But because of this air pocket that was hit, which was a complete self-good, our growth dropped and valuations were high. Now that difference, there are two ways. Either market remains where it is and we have a time correction of say 12 to 18 months till earning catch up. Here, the air pocket was hit and market found a reason to correct. Now, there you can just say that if I sold this and bought China or whatever, in general, that is what it was. The Goras were actually not comfortable with the valuations here and they sold and went somewhere else. And you see at that point of time, there was a Trump rally also, post the elections, etc. So this was largely the reason why market started the correction. So this is it. If you see FII outflows in GFC crisis, $15 billion went out of Indian markets and markets were down 57-60%. Okay. And this was 5% of their holdings in India. In the current thing, they sold about 3% of their holdings. FII holdings in Indian equities now is at its lowest. In fact, the biggest news of last month is that now Indians own or domestics own more equity than foreigners in India. It is first time in history. So FII ownership of Indian equities went down and the market consequently corrected by 15-20%. And then came this. Everybody thought that Trump is just threatening or whatever. But actually, if you see this announcement that he made, it is crazy. The kind of rates, the kind of tariffs that he is talking about. And I'll tell you why. Uh, you so say a Boeing 787 will have a component ecosystem in maybe 100 countries. And if you have different tariffs in each, it's just crazy how to readjust the supply chains. It is very easy to just make an announcement, but to readjust global supply chains is a nightmare. And that is what really, and market doesn't like uncertainty. So when this announcement came and you had, the kind of tariffs that were announced, You see the left-hand side, the newspapers, obviously, prices were down and newspapers were screaming that end of the world kind of story. So I have just listed down because the headlines were screaming Mayday and everything, weaponization of financial systems, Chinese, if they don't supply to US, they will dump it globally. Global trade will slow down, everything, decision making will stop. Fed is not reducing interest rates. So all these things were there. Now we have the benefits. See, at that point of time, this is the note that we wrote. But today, US market is back. The entire fall they have recovered. India also almost entire fall we have recovered. So now in hindsight, we know that these things actually were the best time to buy. It gave us an opportunity after 3, 4 years of one-way run. The air pocket actually was the first real opportunity. And the way Trump was doing it, it is you see the right hand side, the Goldman Sachs thing, that in 73 minutes they had to make a 180-degree turn in their view. So these uncertain times and capitulation followed. All across the board, we saw panic. Also, after that, we saw this, and here I think a little bit overreaction came. We have seen this picture before, Uri and Balakot, or even during the time of war. If you see on the day of strike, or from the day of strike, yes, some downtick has happened. Kargil, there was a 8% downtick, but after that, during the war and 1 year after, big gains were made. So wars are actually, very honestly, I mean, dispassionately, we don't want wars, we don't like wars, but it's not bad for business. Trump is selling F-35s left, right, and center, so it is good for some businesses. So this is the uh, how do you say, uh, this is what it is. So we obviously have to look at it in the right way. That worst part of drawdowns is this, that people hesitate, people, where you want, when the prices are lower, you want further lower prices. So this fascination of trying to time the tops and bottoms makes you miss the woods for the trees. So which is why, I mean, our line at that point of view, you never lose money when market panics, you lose money when you panic. So at that point of time, at the prices at which we were seeing on screen, my message was very clear that there's only one thing you can do. Either you buy or you wait. There is nothing else. There is no point in panicking, because it is not a scenario. In fact, fundamentally, if you see, India is one of the best markets in the world. We have a domestic market. We have an opportunity to export. So there is no other market like India. We have the shock absorbers. We have the balance sheets to absorb any kind of shock. So I'll just take you 1 year back again, 2024. Every month we had some event or another. The yen carry trade, BJP got lower than expected seats, US Fed rate, sharp FII outflows, DOJ probe on Adani. Adani also now we have forgotten. That time there was whether Adani is a risk to the market, tariff tantrum. All these things have happened. But in the long run, this is how the charts look. So markets always climb the wall of worry. So as soon as the market, see, according to me, the tariffs were not beginning of uncertainty. It was the beginning of creating certainty. That yes, he wants to put tariffs, and we saw the worst. Okay, if he's put 26% tariffs on India, then that we have seen the worst. Ab isme negotiation hoga. If you see how he did, and the playbook was there, what he did with Canada, what he did with Mexico. So he first puts it, and then one day later he will come and give some concessions here and there and all that. So we knew the playbook. We knew what is going to happen. We saw the worst, and when market factors, as soon as certainty is there, okay, 26% hoga, so you can price it. Okay, if it is 26%, then this is. So that was the, in a sense, beginning of certainty. And to me, Trump will claim a win, even if now it settles at 10% and all the reciprocal tariffs he does away with. He's moved from 2.5 to 10%. And world will feel relieved. Oh, we thought it is 26% or 59% or 150% in case of China, and then we are settling at a much lower number. So now, if you know the person, then you know everything is a business deal for him and a negotiation tactic. So we have to look beyond the negative headlines. Government has reversed the measures. You see the tax cuts, government spending has again come back. So 12 lakh crores next year. That is all, you know, firmly back on track. This is very important. RBI in 2024 versus RBI under the new governor, there's a complete U-turn. And we are underestimating the impact of this on the economy. But lower pressure on banks to CD ratios was deferred. He announced swaps, etc. Liquidity has moved from minus 2 lakh to plus 2 lakh. And you are seeing it that a lot of easing has been done and they are ready for more. India has done two rate cuts in spite of US holding on to the rates. It's never, otherwise, RBI governor will always wait till US cuts rates. So where is this confidence coming from, Kegora? Because the differential in India's interest rates and US is like very small. So we would fear a lot of outflows, etc. But that's not the case. So that shows that confidence that the RBI has. Recovery has started, though it is very, very slow. So it is not good enough for us to, to our liking. Balance sheets are great, whether it is government, corporate, individual. So shock absorbers are there. Trade war, trade tariff, India in any case is a very small partner to US. I personally believe uh, that the eventual outcome, we will actually have some big winners out of it. So while everybody looks at it as risk, let the trade deal happen. For some sectors at least, a huge opportunity. US is the biggest market in the world, and if US opens up for us, all we need is relative uh, uh, what do you say, competitive advantage. And if we get that, then you will see this $200 billion or whatever is the thing, it will grow. So, this is again one example of, what US has been talking about China. Like every few days, there is a flip-flop, flip-flop. So you cannot make long-term decisions based on these flip-flops. The big thing, if crude is down, if dollar index is down, then it is advantage emerging market within that advantage. That's, if you cut all the noise and if you look at these data points, then nobody, if you are sitting outside and you have trillions of dollars of AUM to handle, and you have to generate returns, then you have to look at EMs for that. So these are the two things, and US bond yields continue to remain high. INR, that is why has strengthened. Our view is that we saw the worst of the INR depreciation. So in dollar terms, in fact, the market bottomed even before it bottomed on the rupee terms. And this is the big thing. We have seen peak US. US exceptionalism lasted from GFC to last year, where they became 70% of world market cap. All the money in the world went to US dollar, went to US for safety. And that is where returns also have been. It is the mother market. It's been the best market, but it's been there for 15 years. Now that leadership, we are not saying that it will crash or anything, but it is unsustainable. Imagine if you again are a global fund manager and you have 70% of your assets in US, where such a big bull market has already happened, then people will be more worried about crypto, more worried about US exposures than they would be about Indian markets. So that is what it is. People sitting outside, there's only one and only one thing, which is valuations. The moment valuations become a little bit attractive, you will see a gush of inflows, and domestic capital has remained strong. Trade deal, I've already mentioned. Whenever it happens, this UK FTA came out of the blue. Again, it's a positive surprise. People are, nothing will happen in 1 year, but over a 5-6 year period, it is going to be UK, EU plus US is the biggest game changer if we are able to pull it through. And, it's only in times like this when there is back to the wall that such a thing actually gets done. Otherwise, years this has been negotiated, nothing has happened. So if it happens, then we need to wake up and understand that this is a truly big long-term tailwind that is going to open up for India. China plus one, I'll just point to the right-hand side of this. I would never have imagined. When we also used to think of China plus one, I would say that 5% of Chinese manufacturing will come to India, 10%. That would be like the bull case. When Tim Cook comes and says that I want to shift 100% of Apple phone manufacturing to India, it is beyond the realms of even the most optimistic guy on the street. Uh, there is some merit to then, whatever. If we can pull it off in 2, 3 sectors, that is going to really create magic. FI net outflow has done. We know that FIs have started looking at valuations have corrected. As I have mentioned here, that they are not attractive like COVID or anything, but yes, we are in a better place than where we were 4, 5 months back. Breadth had collapsed, and now the breadth has started improving. Uh, all world, like I said, US is already back. Entire losses have been erased, and so is India has been a laggard, but you will see India catch up quite fast. All boardrooms in the world would be talking how if you are dependent 80-90% on China, then you have to find an alternative. Vietnam is not, that is also China proxy. So there is only one country, which is India, which can, kind of at, uh, you know, attract this move at a size and scale that US would want. Lastly, where are we in the cycle? We are somewhere in the middle. That is what we feel. Something that had actually started in 2019 with the tax rate cut. Before that, I think the first term of this government also they were not focused on the economy, but 2019 when the tax rate cut came and PLI etc. That is where we knew that they are incentivizing companies to become big, and that's what we as equity shareholders like. The conditions for an unsustainable bubble is this, where you are at the peak of the earning cycle, you are at the peak of liquidity cycle, you are at the peak of economic cycle, and there is highest leverage. That is where you would say there is a point of maximum optimism. So 2008, 2007, actually, or 2001, those were the points where that became unsustainable. Otherwise, there is nothing 15-20% correction, and you are fine. Um, so same thing, this FI outflow point I've already discussed. India has the breadth, India has the depth. Yeah, so this is again the same, after the tech bubble, GFC, etc. So you see the conditions, we are nowhere close to what those unsustainable. Just see that last 5 year return cumulative number. In Harshad Mehta, 740%, tech bubble 3,400%, GFC 500%. We are at 150%. So in that sense, it's not that we are sitting on some massive returns. Etc. Corporate profit to GDP peaked at, this is all listed companies, peaked at 5.9% in 2009, went below 2% in COVID. We are now at 4. So we are somewhere in between. We still have the operating leverage to play out. Still have private capex to play out. We have lower tax rate, lower interest rate structurally than last time. If you put all of this together, in this cycle, we will peak at maybe 7-8%. So we are still halfway where we have to be. This is obviously GFCF or private capex. If we really have that cycle, we can go up to 35%. So that way, this is not peak fundraise, peak liquidity. Uh, all these data points suggest that we are somewhere in the middle. So there's no need to panic. We are not going to see it crash. There are multiple decadal themes, and this is a question I am sure a lot of your clients have on where is the opportunity in the market. I would like to leave this for half a minute on the screen. Energy transition, electronics, manufacturing, private capex, domestic consumption, CDMO, defense are some of the areas which are decadal themes. They will keep giving you opportunity to enter, and this is where we feel, bulk of the opportunities are going. Some of these are new age sectors. So the past, whether it is IT services, whether it is generic pharma, whether it is consumer staples, that is not where the returns are. The returns are in a lot of these new age sectors which are growing very fast. And this is where you are going to see a scale change. They don't have a representation in the index today, but these are index stories of the future in that sense, so to say. So Zomato, for example, just came into the index. So we are seeing or going to see a lot more of these, new industries, new companies. So our bet, obviously, as I said earlier, energy transition is one of the biggest. Within that, there are a lot of sectors, subsectors, which will benefit. This is just the theme. So in short, there we are in the middle of the cycle. There are still a lot of opportunities. Only thing we have to get right is valuations. And you know, valuations also, don't think of it from a PE point of view. That will be very wrong. Aggregates, index PE, all this don't make any sense to us. You have to look at cyclically adjusted PE. Where are we in the cycle? What are the absolute valuations? Do DCF, reverse DCF use? I mean, we have to understand where we are in the cycle and how we should value these companies. Otherwise, if you just look at PE, then you are going to miss out on a lot of these. At the same time, yes, profit, cash flow, that is the main thing. If the companies are going to change scale, then on an exit P multiple of 25, 30 times also, there is a lot of money to be made even from here. So I'll conclude it with this. We are not saying that it will be like a runaway, one way kind of thing, but we have to be convinced. We choose to look at the glass half full. There are a lot of pockets of opportunity. So in the market, for example, IT services, I think they will not grow, or there is a AI threat or whatever, then I can ignore. Even if they have 15% weightage in the index, I will not spend time on that if I don't feel there is opportunity. So yes, we will, market will have a, gyration based on whatever news flow happens or whatever. So, but if you have the conviction, it will surely be rewarded. So, thank you. I'll stop here and take questions.
Sure, sure. Thanks a lot for those insights, sir. While we wait for the queue to build up, there are some questions already being, locked in the queue. Now, so I'll go through them one by one. I encourage all of the attendees and our clients to please log in their questions. The Q&A tab is placed at the bottom side of your screen. With the kind of client interactions that we have, sir, one common question that often gets asked is how to create an anti-fragile kind of a portfolio, given the
Hmm.
uncertainty across the globe, not only India, given the Indo-Pak tensions, also because of the trade wars and all. While you touched upon some of those, pockets of opportunities, right? So, how at this point in time, how is the portfolio designed from the sectoral positioning and the segmental positioning?
See, these are all, yeah, honestly, this is the bulk of the portfolio in terms of themes that is represented. Anti-fragile comes from two things. One, obviously, with the global uncertainty, etc., it makes sense to have a more domestic focused portfolio. How I see it is, see, there are two ways. Mentally, we should be prepared. If I bought at a particular price and it goes down 5-7%, that may happen. This fear of wanting to time the bottom, and after I buy, it should not go down only. That is not possible. So we should not attempt something which is, who knows. I bought the stock when I am comfortable, and then somebody has some pain point and they come to sell. The stock may go down by 5-7%. So in an anti-fragile, high quality, see, what is anti-fragile? It is high quality, which is what we do. We will not go down the quality curve. I'll just put up one more chart. Just give me a second. Yeah. Mm, yeah, let me know when you see this.
Yes, sir, it's visible now.
So now, if you see companies going from ugly to bad, is also delta. Some of these give fantastic returns also, and lot of people, what is called kachra cap, or whichever name you want to call it. Yes, it is a style. It works for many or whatever, but this is absolutely opposite of anti-fragile. So we don't operate in the ugly to bad, bad to average kind of stories. We like average to good and good to great stories. So this is one thing. Finally, if you have high quality and if you are sure of earnings, that is the only counter to whatever is happening. And third is if you see any big risk, normally big drawdowns happen where it is unknown and unknowable. But in general, if you like, I'm saying that AI is a risk, then today, before buying a stock which is operating in a domain which can be disrupted by AI, I will put three more filters before I go and buy even a single stock. So you have to build your mental models in terms of what you are going to avoid, and that takes care of 90%. So, in the five decisions that we have to take as a fund manager, क्या लिया, कितना लिया, कितना होल्ड किया, कब बेचा, and the fifth is क्या नहीं लिया. So the fifth thing is as important as the first four. So in building an anti-fragile portfolio, I think the last plays the most critical role on what you would avoid.
Sure. So you have touched upon, the changes that the new RBI governor has put in place, right? So all the
Yes.
liquidity enhancement measures,
Yes.
LCR, OMOs, all of that. So
Yes.
any within the BFSI sector, any picks that you are little keen on?
Not going to talk about stocks. Sorry for that.
No,
See,
within the
I am telling you future
yeah,
actions. I'll tell you philosophically. There's no
yeah.
point in me discussing future actions. I will take the actions, whatever is there. I don't want to talk about it before I have what. So that's very, very clear. We have identified areas where we are interested in within the lending space. Broadly, I feel men and boys separation will happen. Last 2, 3 years have been kind of Cinderella period for them, where NPAs were close to zero, and all these. This is not those kind of golden periods are not. So we will have normalization of credit costs, and that is where men and boys separation will happen. Whatever was ugly quality also, because NPAs were zero, the PNLs were looking very great. But the real ROAs in the year 26 and 27, we will know what is the real ROA. Very few financial institutions are able to make more than 15% ROE with even a 15% growth. So it is that rare. Plus, it is a leverage business. So in that sense, yes, as a trade or whatever, a lot of things may make sense. But if I have to invest and I have to be in a sidecar, then I want to be with a responsible lender where I can sleep peacefully. And that way, there are very few companies that make the cut in terms of just this same thing, okay, 15% growth and 15% ROE. If I put just these filters, and I'm using the word sustainable. Last year, a lot of people would have done that because their credit costs are zero. So within lenders, be careful because you are going to see normalization of credit costs. So that's the only thing I would say. I have a list of stocks that I own. I have a list of stocks that I am interested in. And I look at BFSI in total. So financial services, insurance, all pockets. There is no compulsion to only buy banks or.
Yeah, sure. So what I basically meant was, sir, any sectors that you would like within the BFSI sector would like to
I have
avoid?
I have shortlisted. See, honestly, my this is my filters. I
Yeah,
want 15% growth and sustainable 15% ROE. So that is where my focus will be. It
sure.
doesn't matter if it is banks, if it is a lender, and like I said, multiplicity of growth drivers. So monoline, I will be a little more careful.
Sure. Mm, Sir, recently you came up with this defense sector report, right? So, and it's
Yes.
very pertinent given the kind of geopolitical tensions that we are seeing, right? A lot of companies, even the startups, developing counter drones, missile technologies, most of it in-house, indigenous in nature. BrahMos is in news. Even the US, Saudi Arabia, 140 billion deal which was announced today between the nations, one of the largest in the history, right? So, within the defense, which subsectors would you be keen on, or would you be positive on?
So if I have to break it up, see, Army, Navy, Air Force. Army spends bulk of its budget on people. There is very little left for CapEx. So for us, I will avoid what is Army facing, and I want to focus on what is Navy and Air Force facing. Uh, Within that, Navy is most indigenized. Air Force still like HAL is suffering because GE engines are not available and stuff like that. So there is external dependence on Air Force while we are talking about BrahMos or Akash Tir and stuff like that. Largely, there was French equipment also that was used as 400 is a Russian equipment. So there is a foreign element to it, which I can't play through the equity markets. There are monopolies within, so obviously government wants everything to flow through the public sector. So in that sense, private sector opportunities are limited, where companies can really scale and stuff like that. So uh, if we really open up, if, and it's a big if, that's a huge opportunity. We have just launched a private equity fund where large focus is on defense and aerospace. So we hope to catch all these companies early. We are ultra bullish on the segments, but it is dependent on government policies. Today, all policies are favorable, and I think from the defense acquisition. So now it's been 5 years since DAP has been there. This year we expect the next 5 year new DAP2 which gets announced. That is going to again redefine. But in general, I would be focused on Air Force and Navy facing, and large part of my capital will still go into the public sector because that is where actually size and scale is. Private, uh, we have to see, and we have to also see how much capital can be deployed.
Yeah. And since you touched upon your PE fund, the second launch after your scale, which
Yes,
was the maiden fund, right?
yes,
And
yes.
your team also wanted to touch upon this topic, right? So it's a very unique theme, right? So you invest in defense sector, you aerospace, energy transition,
And
all of these
precision
like
engineering.
relatively
Yes,
new age sectors. So would you
yes.
like to touch
Yeah, so
upon
this
this?
is,
Yeah.
I think this we are at a very nascent stage in all these industries. When we saw and we identified this, scale is going to be a large fund and making, the larger investments. But there are a lot of these smaller companies which are maybe 2, 3, 4, 5 years. They have some contracts, some export contracts, etc. Who need. So one thing is for sure, the business economics have to be established, profitability, unit economics has to be established, and we will only give capital for growth. So this is not angel investing where on an idea we are going to put in money. It is where some proof of the pudding has been there. Our edge here is very much versus others because the two fund managers who are going to manage the money, one of them is a scientist who was in BARC and who understands, the physics, the nuclear physics or this defense space very well. He's been insider also in the government and now is with us. So there we feel we have some kind of a edge. Some examples what we did from our private equity scale one, which is Unimac, which is on the aerospace side, or now Ranksons, we've already announced that the first deal we've done from TriStar, which is the new fund. So we believe these industries are at a nascent stage. Next 5, 7 years, all these companies will change scale materially, and we wanted focus on that. We will only launch a fund where we think we are going to make money, and as you know, we have complete skin in the game wherever we launch anything. So this is a relatively smaller fund, 50 to 150 crore kind of funding in each and every idea, maybe 8, 10 ideas, and that is what we want to do. So we'll be very selective in finally where we write the checks, but it's a very exciting space.
Sure. So I don't think there are any questions in the queue, sir. So from the Q&A point of view, those were the questions from the investor side and from our side. Many thanks for the insightful session, sir. Some of the pointers that you pulled out, they were very granular, lucid, very helpful for the clients. The sectors and the opportunity that you pointed out, some of them are long-term mega trends. So I'm sure the investors have a lot of takeaways from this session. So many thanks for accepting the invite and being the guest speaker for our Alpha Manager series. Team, that was it from our side. That concludes the call. We will come up with many such differentiated ideas in our Alpha Manager series. So do keep a watch on this sessions. So thank you everyone. Thank you, Samir sir. That
Thanks,
concludes the
everyone.
call.
Bye.
You may please log out. Thank you.